Okay, so can you hear me clearly? Yes, so because actually what we want to cover is not just a simple tutorial, it's more like a small lecture plus the tutorial questions. So I can't guarantee we can finish all the contents in 1 hour. If we couldn't, we may also need to extend the discussion in the 8 p.m. tutorial. Okay, so bear in mind, if you could still be available for the 8 p.m., we can still go there. All right. So to save the time, let's go to the tutorial question. I would also encourage you to speak out. And so if you have any queries, just let me know orally. So we are not, even though we have very heavy content, we are not in a rush, which I just try to make at least you and who's in this class tonight understand the key contents as much as possible, okay? So last week, the topic would be about subsequent events and also the order reporting. So basically there would be two parts of the key knowledge we must understand. So first, in terms of the subsequent event, okay, in terms of the subsequent event, so there are two things we have to pay attention to. The first thing is what is a subsequent event? For the subsequent event, the first part is so only the new information and only the new important information will be observed and will be paid attention by the auditors in the subsequent period. So what is the subsequent period? The subsequent period means the date after reporting date. So for most of the Australian companies, that would be the date after 30th of June. However, auditors' responsibility in those period, in the subsequent period, could be different in terms of period 1, 2, or 3. Period 1, if we look at the screen, period 1, that is from the date of 30th of June, from the reporting date, to the date auditors sign up the auditor's report. This is called period 1. In this period, auditors have the responsibility to discover and evaluate all the subsequent events that are material on the financial reporting. So that also means, so for period 1, new situations arising in period 1, auditors should be very active to discover and evaluate their impact as a subsequent events. Period 2, that is from the date of auditor's report signed to the date the financial statement has been issued to the shareholders. So what is period 2? That is, so usually once the directors and also auditors sign up all the financial and auditors report, the company may still have some time to prepare all the documents and officially release those reports to the members or the shareholders. Because in period 2, the directors and auditors still have control over the report. So they still have the flexibility and opportunity to correct if they know there are some omissions or mistakes. So auditor's responsibility in period 2 is to examine the events that come to their attention. They should know before, but now they know, okay, so we may not pay attention to those events before, but now we realize those are important. So auditors can still respond to those subsequent events. Period 3. Period 3 is still called as the subsequent period. However, after the auditors and also after the financial statement has been issued, has been released to all the shareholders and members, now actually the directors and auditors do not have the control of those information. So for period 3, so if the auditors notice they have missed any important subsequent event information, they haven't properly reported on them. Now they want to revise, correct, to provide a more correct information to the shareholders. Then auditors would only examine the events that are very, very important and that come to their attention. And also, if auditors want to do some further corrections in period 3, actually that is a restatement, because auditors need to, the directors and auditors need to recall the released financial statements and auditors report and make corrections on that. Okay, so that also means yearly auditors wouldn't respond to the events arising in period 3 unless they should have picked up that in period 1 or even in period 2. Okay, so in terms of events arising in the subsequent period, they could be categorized as could be classified as 2 categories. One is adjusting events. The other one is non-adjusting events. Remember, for events arising, for the subsequent events arising in the subsequent period, we only pay attention to those important, significant, or material events. So if the events coming to your eyes, but it's not material enough, as what we deal with information before the balance date, you don't have to report or respond on that. Okay, so remember, no matter it is adjusting or non-adjusting, for any subsequent events, auditors will only respond to the events as long as they are material. But for the material events, so in what situation the events will be classified as adjusting or as non-adjusting? So remember, we have 2 steps of this theorem. Could you see the screen? Okay, so as I mentioned first, those information have to be material. Second, so those material subsequent information could be adjusting or non-adjusting events based on the decision whether it is related to the new condition. If it is about new condition, then it will be classified as non-adjusting events. So would only be disclosed in the disclosure. If it is about old condition, it has to be adjusted in the financial statements or adjusted in the notes. So what is new condition? What is old or existing condition? So for existing condition, that is the condition that existed at reporting date, but the company hasn't been aware of, or the auditors hasn't been aware of. As we could see from the slides, there are a few examples. For example, one of the major data has been bankrupted, but the major data and also the balance existed before the balance date. And also the bankruptcy situation should also have existed before the balance date, but the auditor and also the company's directors didn't realize it. So in that situation, the bankruptcy situation of major debtor will be considered as an adjusting event. The second example, settlement of litigations as a different amount. Suppose this company has a litigation have been raised up but haven't been fully settled. Now, in the subsequent period, the new outcomes of the settlement has come to your attention. Then, because the litigation was there, and the settlement terms and conditions of the settlement actually should have been existed before the balance date, but you only know the result. The result has only arising, has only been formally issued after the balance date. Therefore, the new settlement decision of an existing litigation would also be recognized as an adjusting event. Okay. Number 3. So equipment disposal actually is about the value of the assets. So suppose the assets the situation of the assets has been changed. For example, before the balance date, there was an estimate of the value to this equipment, but after the balance date in the subsequent period, now we know the market value of the settlement of the disposal of this equipment. So the value actually has been updated, but the value actually exists at the balance date. Therefore, we are going to also update or adjust the value of the equipment in the financial statement as well. Okay, and the fourth example, so fraud or discovery of major mistakes in the financial statement. So the errors, fraud or mistakes existed there, but you only discover that in the subsequent period. Of course, you are going to make adjustment as an adjustment as an adjusting events. Okay, so if we could understand what is adjusting events, of course, those other things which are not recognized as an existing events will be recognized as new conditions and will require disclosure in the notes. For example, decline in the market value of the shares, decline in the market value of the inventory. For example, the issuance of bond or shares. For example, if there is a natural disaster and the net losses from the natural disaster which is not insured would also be recognized as the non-adjusting events. Yearly for merger and acquisition plans would also be recognized as non-adjusting events. Okay, any question here? So in your decision making, first, are they new information? Second, is this material? Third, is this about new condition or old condition? Then you can make your decision, okay? Okay, all good. One thing I want to emphasize here is in the adjusting events, we say they are going to be adjusted, but the place of the adjustment could be in the financial statement if the correction or the adjustment should be in the financial statement. Or it could be adjusted in the notes, right? For example, if it is about contingent liability, contingent assets, of course, it should be included in the notes. And then when you make this adjustment, you should also adjust in the notes. Get that? So adjustment would mean the proper adjustment in the financial statements, also possibly in the notes. Okay. So are you interested in going through the lecture example? Okay. I know if you have listened to the recordings, so you should have already gone through those lecture examples, but I'm still happy to go through those examples with you together. Okay, so look at the example. So you are in the process of completing the audit for the year ended 30th June and intended to sign the report on 25th of August. The following material events occurred or has been discovered after 30th of June. So let's decide, are they adjusting or non-adjusting events? Okay. So let's see the first one. On August 9th, company's major debtor has gone bankrupt on 3rd of August. The cause of the bankruptcy was the unexpected loss of a major lawsuits issued against this debtor on 15th of June. So what could be your answer? So apparently that's new information. And the bankruptcy of the major debtor tends to be quite material, right? And it is due to the major lawsuits of this customer before the balance date. So that is about old condition. So what is your answer? So that will be adjusting. Very good. So the second, still on 9th of August. So the major debtor has gone bankrupt in August. The cause was a major uninsured fire at one of the debtor's premises on 15th of July. So still new information, material. Is this about old condition or a new condition? So it is new condition because the condition only arises due to the newly happened natural disaster. So what is your decision? Adjusting or non-adjusting? So that would be non-adjusting, I guess, right? Make it smaller. Okay. Number 3, 20th of August. The dynamic CEO suddenly left the company after disagreement with the board. He was considered to be the driving force behind the success of the recent years. So is this new information? Yes. Is this material? Because the leaving will have impact on the success of this company. So it is also quite material for the going concern of this company, right? Is this old or new condition? No information. So there's no information about this So because the information is not fully disclosed in this short sentence, however, those information is quite material, quite important for the company. And I suppose it seems to be about new conditions. Unless in your query with the management, has been got when you discuss with the company's management. So basically you are going to talk with the management, with the directors to figure out the underlying reason of this leave. So if this leave was about the previous situations, you didn't know, probably that's old condition. If it is a fully fresh information for everyone, and there's no underlying existing situations within the organization, then it could be new condition. So yes, I agree with you. So we couldn't, the information is not very full in this question. Number 4. So the division got a large print of the book, The Secret Life of Raymond, was produced in July. As at 30th June, stock of raw materials has been piled up. On 28th of August, Raymond was killed in tragic circumstances when he rescued a young child from burning house. So the company pumped the book on 5th of September after receiving advice, now selling a book about Raymond's tragic and hero death would result in a severe public backlash. So still, I think still new information and also material, right? Because that represents a large amount of the inventory stock in this company. But is this about new situation or old situation? So is this about old situation? So when the incident has happened, 28th of August, right? So when the auditors have signed up the audit report, 25th of August. So basically that is within the period 2 or period 3. So auditors would only pay attention to the information coming to their attention. If this information doesn't really come to their attention, they don't have to pay enough. Yes. So that is the subsequent events, however, in period 2 or 3. So, and also, is this, so, and also this new information arising after the reporting date. So that is new condition as well. So now let's have a look. That's new condition, and also new condition was came to your attention in period 2 or 3. So for this situation, we recommend maybe no action. Okay. Number 5, research division has developed a new type of photocopy paper. So the directors believe it will increase their sales volume significantly. As a result, company capitalize the cost. However, on 8th of July, the application for the patent was rejected because competitor has registered the patent in June. So apparently still new information and also material. Is this new or old condition? So it's still old condition because actually the patent of the competitor has been granted in June, so before the reporting date. That would also means the application should have been rejected. The situation, the grant will be rejected has already been decided before the reporting date. So adjusting or non-adjusting? Non-adjusting. Oh, sorry, adjusting, sorry. So adjusting, okay. Number 6, the company holds investment in several companies listed in Hong Kong Stock Exchange. In the last 3 months, the exchange has losing about 1% of the value per month. So altogether, that's 3%. On 11th of August, exchange value plummets by 25%. So for the 3% of the last 3 months, they are new information probably, but they are not that material, right? However, what we focus here is the 25% drop on 11th of August. So new information and also new, because it is happening on 11th of August. So this is non-adjusting or disclosure events. Okay. Any question here? So we also have the solutions given here under the slides in the notes. Any question, please? All good, okay. So let's also move on to another example. So this is the tutorial question, right? So could you read it and also draft out your own answers to this question? So first, what is the new information? Second, whether or not it is material and why it is material. Third, so is this about old or new condition and why? And then make your decision. You ready? Okay, looking the question together. You are the audit partner for the year ended 30th June. So the company designed and constructed water purification plants and equipment. In December last year, the company acquired 100% shareholding in Crystal Lake Water Limited, one of the largest producers and distributor of bottled mineral water in Australia, with contracts with all the major supermarket chains and the liquor companies, liquor stores in Australia. Now it's late August 2018. So while finalizing the audit, you come across the following information. First, so the standard customer contract contains a clause allowing cancellation if the company's own ownership change within a specified period. A few of the major customers' contracts have been canceled since year end. Second, heavy rain and subsequent flood during late July has seeped into the underground water table in West Victoria and contaminated one of the major sources of the mineral water supply. This will cut the company's production by 50% in the next 3 or 4 months. So we got two situations. Please consider the situations independently and then discuss. So how would you include this item in the consolidated financial report? Basically, how would you deal with those newly known subsequent events? Any idea? Okay, so in the first situation, the standard customer contract contains a clause allowing cancellation within of the ownership changes. If the ownership changes within a specified period, and now 30% of the revenues has been impacted because a few customer contracts has been canceled since year end. So apparently, in the first situation, that is new information, which is also very material. The question here is whether or not it is the existing or old condition. What is your judgment here? Why do you think it is old condition? It is because, so the contract has already been there specifying those contracts will be canceled in certain situations. So as long as the clause is there, and as long as they know they are going to, they have entered into the new ownership, then those contract cancellation would have happened before the reporting date, right? So for the first one, that is new information, material, and also about the old condition, because the clause exists before the report date. So the impairment of the goodwill should also be adjusted. So in the first situation, that is old condition regarding newly known information. In that situation, adjustment need to be made. Can I also know what type of adjustment need to be made in this situation? So this is new information about the ownership will have impact on the goodwill of the new purchase, right? So it is about existing condition based on the contracts. Therefore, we are going to do the we're going to recognize this one as the adjusting events. What to adjust is to adjust the goodwill recognized. Okay. Because in this question, we are asked to consider the situation independently. So your decision about situation 1 wouldn't affect your decision in situation 2. So what happened in the second situation? Of course, it's still about new information. So this is new information. About water contamination will have impact on revenue, on future revenue, and maybe also something regarding the company's going concern and also the market value, right? So is this new condition or old condition, please? So the natural disaster has been occurred after the balance date. So apparently that's new condition. So that is non-adjusting, but to be properly disclosed. Okay. So the answer is in the next page. You can come back to revisit the solutions after the class. Okay. So that is the first part of the essential knowledge from last week's topic. Now we are going to also cover the second part, audit reporting. Okay, please follow me. So this page will be very, very important regarding the audit opinions. So what we want to know is for most of the audit opinions, audit reports, the audit opinion should be unmodified. Okay. Unmodified opinion consists the majority of the audit reports. And that basically means auditors have no reservation to the material information existed in the financial statements. In some situation, so the auditors feel they don't really have any reservation regarding the audit report. However, they feel they still need to emphasize something to make the readers, the financial statement readers, pay attention to certain information. So in that situation, they are going to issue the unmodified audit opinion with emphasis on matter or other matter paragraphs. And we are going to discuss this in the next page. Okay. So, however, those two situations are still about unmodified audit opinions. One is without any further emphasis, and the other one is unmodified audit opinion with emphasis on matter or other matter paragraphs. So apart from those two types, we also have other three types of audit opinions. One is qualified audit opinion. The other is adverse opinion. The other is disclaimer. Are you still following? Thank you. So it is based on the classification on whether it is a disagreement with management or whether it is due to limitation of scope. For disagreement with management, we also could use another word, that is material misstatements. So for the situation of existing in uncorrected disagreement with management, existing not corrected material misstatements, so auditors will issue either qualified opinion, or if it is very extremely material, if it is pervasive, then that is adverse opinion. On the other hand, the other reason of modification is limitation scope. Another word for limitation scope, that is unable to obtain sufficient audit evidence. So if it is due to limitation scope, if it is important, if it is material but not pervasive, auditors will issue qualified opinion. If it is material, then auditors will issue disclaimer of opinion. Okay. However, so in some situation, so limitation scope are imposed not by the circumstances beyond the auditors and client's control. So those limitation scope was imposed by the clients intentionally. If the limitation scope was imposed by clients intentionally, so that actually means the client or the directors impose restriction for auditors to get access to the information from this company. So in that situation, auditors would usually rate the situation more seriously, more materially. So they tend to make a more serious audit opinion, tend to be disclaimer of opinion. You still following? One thing here is, if you really look at the audit reports or audit opinion in the market, you find actually most of the companies will be unqualified audit opinion. Or if there are some serious issues, auditors issue unqualified opinion with emphasis on matter or other matters. It is quite not so common for us to rate qualified audit opinion. And it will be even rare for you to see disclaimer or adverse opinion. It is because, so when the readers, when the market see those qualified, modified audit opinions, they know they are very serious. So they will have a bad perception to the company. So sometimes auditors just want to qualify the audit opinion as a part of their engagement. However, those opinions may have very substantial effect to the company's future survival. With this consideration, then, I think, which one, I'm coming back to you, to your question very soon, Ganna. So that's why, so in practice, even though in theory, we have 5 types of audit opinions, but in practice, it's not so common for us to find adverse or disclaimer of opinions. Okay. However, in our theoretical questions, for example, for the questions you see from the final exam, for example, so you just follow the decision tree. So first, is this unqualified? Are there anything need to be emphasized? Third, and then, is this serious enough, mature enough to issue the qualified opinion? And then, is this more serious? Is this extremely serious for you to issue adverse or disclaimer opinion? Okay, did I explain clearly? Okay, so Ghana got a question regarding which one is worse, adverse or disclaimer? Equally worse. Okay, so those two opinions, adverse means fundamentally auditors don't think the financial statement is true and fair. Disclaimer means auditors couldn't issue the audit opinion. They refused to issue their audit opinion, so they are equally serious. Okay, have I answered a question, Ghana? All right. So the other one page I want to draw your attention to from the slides was about the difference between unmodified and other matters. Between the emphasis of matter or other matter paragraphs. So in most situations, auditors will issue the emphasis of matter paragraph if they feel the circumstances need to be emphasized. As described in ASA 706, there are certain situations usually attract the emphasis of matter paragraph. For example, if there is a significant uncertainty in terms of the company's going concern status, in terms of the uncertainties on the future outcome of events, or if the company has early adoption of the new accounting standards, or if there is a major natural disaster. So those are usually situations that should be considered as the emphasis of matter. So in other situations, so the auditors might issue the unmodified with other matter paragraph. For example, the auditors want to communicate some significant risks identified in their audit procedures. If they are not included in the key audit matter paragraph, auditors may disclose that in other matter paragraph. Or the auditors has a limited of scope situation, which is pervasive, but auditors, to some reason, auditors are unable to withdraw from this engagement. Then auditors will also put other matter paragraph in their audit report. Also, you can read this through. The one often happens thing is inconsistent other information in the documents. So previously, before the adoption of the new auditing standards, this situation, so the inconsistent information in the annual report was previously included as emphasized matter, but now it has been included in other matter paragraph. What that mean? For example, we know in auditors' auditing scope, auditors are auditing the financial statement and notes and also the director's declaration, right? So auditors do not have the auditing responsibility over other parts of the annual report. But what is the auditor's responsibility in the other part of the report? That is, they need to read through the other parts of the annual report to ensure there's no contradictory information which are contradict to the information in the financial statements. If they found some information in the other parts of the annual report are inconsistent, they should ask the management, the directors, to make corrections. If the directors refuse to correct, then they need to disclose that in other matter paragraph. Okay? You still following? So I want to keep your attention to the inconsistent other informations in other parts of the annual report, those is a special situation for other matter paragraph. Okay, still following or not, please? Okay, so the other page I want to pay attention, attract your attention to is the going concern opinions. So in auditor's conclusion, in audit opinions, there will be three different situations in relation to going concern. For example, if the financial report has been prepared on a going concern basis, but auditors think actually they need to use the liquidation-based accounting. So the fundamental basis of the accounting has been disagreed. Of course, it is pervasive for the company's financial statements, right? So in that situation, auditors should issue adverse opinion because fundamentally the accounting basis has been incorrect. In the second situation, so overall going concern basis is still appropriate, but auditors know there are material uncertainties. They know these material going concern uncertainty exists, but the company, the directors has already made a proper disclosure of this going concern uncertainty in their financial statements. In this situation, actually nothing wrong with the financial statement because the directors has already properly disclosed the going concern uncertainty. But yearly, auditors still want to emphasize this situation in their audit report. So they are going to issue unmodified audit opinion with emphasis and matter on going concern. All right. So in situation 3, going concern basis is good, is okay for this company, but there is a material uncertainty exist. However, the directors didn't make a proper disclosure of this going concern uncertainty in their financial report. So that actually means the financial report has been misstated. So in this situation, auditors will issue qualified opinion, or if this uncertainty has been pervasive, they can even issue the adverse opinion. Most likely, they are going to issue the qualified opinion on the going concern uncertainty because the disclosure is not adequate. Okay. So I guess we don't really have enough time to cover the remaining questions. So I'm going to continue the discussion in the 8 p.m. tutorial. If you're still interested in those questions, you can come again to discuss with me together. Otherwise, I'm going to make recording to those questions as well. So thank you for the participation in this 5 p.m. tutorial. And I see you in the lecture and also maybe in the 8 p.m. tutorial. Yes, so the 8 p.m. tutorial will start from 12:23, yes, yeah, and then I may go back. So if the other new students newly joins to the tutorial. Okay, so thank you. See you very soon in the lecture.